Welcome back, Focus Learners. Today, we're taking a really deep dive into one of the most highly anticipated public market debuts hitting the street right now, the Milky Mist IPO. Now, if you've been anywhere near the financial news lately, you know there's a massive amount of buzz surrounding this launch. But you know us, we aren't here for the hype, we're here for the hard facts. In this explainer, we're going to literally pull back the curtain and look at the fundamental architecture of this offering. We'll analyze their operational moat, dig into those surging financials, and weigh the actual long-term realities. It's time to uncover exactly what's going on beneath the surface of this dairy giant.
So here's our roadmap for today. First, we'll hit the Milky Mist IPO overview. Second, we're looking at their value-added business model. Third, we'll break down the surging financials and valuations. Fourth, we'll cover short-term listing expectations. And finally, fifth, long-term growth and risks. Let's get right into it.
Section 1. The Milky Mist IPO Overview. The Hard Facts and Dates.
Okay, here's the sprint schedule for this rollout. Anchor bidding kicks off on August 10th, but the window you really need to mark on your calendar is August 11th through the 13th, because that's when the IPO is officially open for subscription. Right after that, allotment is scheduled for August 14th, leading up to the grand finale, which is the official listing date on the exchanges on August 18th, so these are your absolutely crucial waypoints moving forward.
Let's dive right into this allocation breakdown, because this tells us exactly who gets a slice of the pie. The qualified institutional buyers, or QIBs, they can take up to 50% of the offering. But what's really great to see here for everyday participants like us is the retail allocation. Retail individual investors are guaranteed not less than 35% of the reservation quota, and then the remaining 15% minimum goes to non-institutional investors. Honestly, it's a structurally healthy allocation that leaves a lot of room for retail participation.
So what does the company actually plan to do with this massive influx of cash? We're looking at a total issue size of roughly 1,553 crore rupees. But here's the kicker. Over 90% of that, specifically 1,428 crore, is a fresh issue. The two biggest buckets here, well, first is debt repayment at 496.8 crore. And then a massive 469.2 crore is dedicated to expanding their facility down in Perundurai, Tamil Nadu. They're also funneling another 155.3 crore specifically toward infrastructure and their cold chain. So they aren't just cashing out, they're actively pumping this capital right back into the physical machinery of the business.
Section 2. The value-added business model, the engine of the company.
If there's one single phrase that completely summarizes Milky Mist's strategic philosophy, it's this: from pouches to profits. This represents a deliberate, total pivot away from the traditional dairy playbook. Instead of fighting a brutal, super low-margin war selling traditional liquid pouch milk, Milky Mist has shifted 100% away from that. Today, they operate entirely as a value-added dairy and FMCG company. This shift right here, that's the real profit engine.
To make this whole value-added concept a bit more concrete, let's look at their actual product portfolio. In core dairy, they aren't just selling plain milk, right? They're selling paneer, mozzarella, cheddar cheese, curd, ghee, and butter. Then you've got their FMCG extensions, ice creams, ready-to-eat desserts, frozen parathas, plus premium sub-brands like Brias. They are laser-targeted at quality-conscious consumers, which basically allows them to command a premium price over legacy cooperatives like Amul or Alvin. So what actually protects this premium portfolio from competitors? It's their operational moat. Beyond just focusing 100% on higher-margin goods, they have absolute, total control over their logistics. We are talking 32 chilling centers, hundreds of refrigerated trucks, and this incredibly impressive mega-automated 55-acre facility in Erode. It literally uses robotic production lines to process 1 million liters a day. This integrated farm-to-retail cold chain? Yeah, that's not easily replicated by new players. It's a massive barrier to entry.
Section 3. Surging Financials and Valuations. Let's look at the scorecard.
Okay, what's really staggering about these numbers is the sheer velocity of their recent growth. Just look at this revenue climb, from 1,821 crores in FY24, stepping up really nicely to 2,349 crores in FY25, and then just surging to over 3,138 crores in FY26. That is a 33.6% year-over-year revenue increase. But you gotta follow the net profit, the PAT. It goes from a modest 19.4 crore, slightly up to 28.1 crore, and then, boom, it absolutely explodes in FY26 to 127 crore. That is a jaw-dropping 176% year-over-year jump in net profit, right before the IPO.
And that massive spike in profit brings us to this big number right here, an implied market valuation of approximately 10,778 crore rupees at the upper price band, with a price band set between 133 and 140 rupees per share and a minimum retail investment of 107 shares at 14,980 rupees. This valuation really anchors the incredible scale of this offering. The market is very clearly pricing in that explosive FY26 growth we just looked at.
Section 4. Short-term listing expectations. The hype. Based on current market conditions, the gray market premium, or GMP, is hovering right around 30 to 31 rupees per share. When you add that to the upper price band of 140, we get an estimated listing price of around 170 to 171. For a retail investor, that translates to an expected listing gain of roughly 21% to 22%, or an estimated profit of about 3,200 to 3,300 rupees per lot. Now remember, we always impartially report these figures. They are just a reflection of current sentiment, definitely not a guarantee, and they are highly subject to daily market volatility.
To keep things balanced, let's look at this short-term outlook side by side. On the positive trigger side, Milky Mist commands a really robust 19% market share in organized packaged Paneer, which drives strong retail visibility and healthy demand sentiment, supporting that 21% GMP. However, on the flip side, the very real short-term risks include broader market volatility that can easily wipe out those listing day gains. On top of that, any sector-wide pre-listing corrections in FMCG or dairy could suddenly cool off all that momentum.
Section 5. Long-term growth and risks.
The verdict.
So the crucial point here is how this IPO structurally changes the business for the future. The key growth drivers are honestly pretty powerful. First, their unwavering focus on those high-margin value-added categories like paneer and cheese keeps top-line growth really strong. But more importantly, remember that 496.8 crore from the fresh issue earmarked for debt repayment? Well, deleveraging the balance sheet directly reduces their interest burden, which will inherently improve their profit margins going forward. And all of this is protected by that farm-to-retail cold chain moat we talked about.
Now, let's weigh those drivers against the long-term realities, because despite the fantastic growth trajectory, Milky Mist does face some serious headwinds. First up is input cost volatility. Milk procurement prices are highly seasonal, totally dependent on things like fodder and climate. Second is geographic concentration. A huge portion of their sales is still heavily concentrated in southern India, meaning there's some significant penetration risk as they try to push into the north and west.
And that brings us to the most critical risk of all, and the question I want to leave you with today. We saw their net profit jump an incredible 176% to 127 crore just as they prepared to go public. For any focused learner looking at the long-term fundamentals here, the key metric to watch over the next few quarters is exactly this. Is that sharp FY26 pre-IPO profit spike actually sustainable in the long run? Or was it just a perfectly timed peak? Think critically about how that dynamic shapes the almost 10,800 crore rupee valuation. Thank you so much for joining me on this deep dive. Keep analyzing, keep learning, and I'll catch you in the next explainer.